Hey everyone, let's jump straight into this explainer. For a long time, Wall Street looked at Snowflake and just saw a really successful cloud data warehouse, right? Just a highly effective place to store and analyze data. But wow, over the last year, there's been a massive shift. Snowflake is transforming into a high-stakes AI battleground. So today, we're going to strip away the hype. We're looking strictly at the numbers, the actual product adoption, and the intensely competitive landscape to figure out, is this AI pivot actually paying off?
To really anchor our understanding of this massive identity shift, we just need to listen to this bold claim from their CEO, Sridhar Ramaswamy. He states, point blank, Snowflake sits at the center of the enterprise AI revolution. That is a huge statement. He's basically arguing that the promise of AI is finally real, and for over a decade, Snowflake has been quietly building the exact foundation needed to make it safe and scalable for big business. They don't just want to store your data anymore. They want to be the engine that intelligently puts it to work. So, here is our roadmap to unpack all of this. First, we'll look at the AI Data Cloud. Then we'll dive into their financial growth and RPO, followed by the profitability challenge. After that, we'll break down their consumption model flywheel, check out the intense Databricks rivalry, and wrap up with their core strengths and market risks. Let's get right to it. Section 1, the AI Data Cloud, beyond data storage. Okay, so here's the absolute core of their new pitch. Snowflake is positioning themselves as the foundational layer where enterprises can build and natively run AI applications. They use this specific phrase. They want to be the control plane for the agentic enterprise. Basically, they want businesses to plug their proprietary data, their tools, and their AI systems directly into Snowflake. This allows intelligent AI agents to automate super complex workflows, all without the underlying data ever having to leave the platform. It's a closed, secure loop. And look, you might be thinking this is just aspirational marketing, but the traction they are getting is incredibly rapid. Consider these numbers. Snowflake Intelligence scrapped over 2,500 accounts in just 3 months. Cortex Code, adopted by over 4,400 customers. By giving businesses the ability to run native large language models, including their very own open-source Arctic model, directly against governed data, Snowflake is completely bypassing the need to export sensitive information to risky external systems. That is a massive selling point. Moving on to Section 2, Financial Growth and RPO, the scale sequence. Let's look at the actual quantitative reality here. So are enterprises actually opening their wallets for this expanded AI vision? The short answer is yes, absolutely. Snowflake brought in a massive $4.68 billion in total revenue for fiscal year 2026. That is a 29% jump year over year. But here's the kicker. Their product revenue growth actually accelerated to 34% in the first quarter of fiscal 2027. When a company nearing $5 billion in revenue manages to actually speed up its growth rate, that tells us something structural is happening. It's a huge indicator of rapid AI workload adoption. And they are doing this across a seriously impressive base of over 13,900 global customers. We're talking about hundreds of the world's biggest companies here, including nearly 600 of the Forbes Global 2000. But the stat that really stands out to me, they now have almost 800 individual customers who are each generating over $1 million in trailing 12-month product revenue. They are landing massive whales over and over again. All of this enterprise confidence perfectly shows up in their remaining performance obligations, or RPO. This metric hit an absolutely incredible $9.77 billion at the end of fiscal 2026. Since RPO basically represents committed future revenue, seeing it grow by a staggering 42% year over year is a really big deal. They are being driven by massive commitments, including one single contract worth over $400 million. It's a crystal clear signal that customers are deeply buying into Snowflake's long-term roadmap. Which brings us to Section 3, the profitability challenge, the cost of growth, because hypergrowth at this scale rarely comes cheap. Think about the financial juxtaposition here. On one hand, you have this incredible top-line total revenue of $4.68 billion and a really healthy gross profit of $3.14 billion. But on the other hand, that is directly offset by a massive GAAP net loss of $1.33 billion. Yes, billion with a B. This heavy loss is entirely driven by aggressive spending on sales, marketing, and especially research and development. Building out all these cutting-edge AI capabilities takes a whole lot of cash. And if you dig into their proxy statement, it adds a really fascinating layer to the financial picture. It maps out executive compensation against that GAAP net income trajectory over the last few fiscal years. It gives investors a totally transparent look at how leadership rewards align, or, sometimes diverge,
with those heavy bottom line losses the company is actively sustaining just to aggressively capture market share.
All right, let's shift gears to Section 4, Consumption Model Flywheel, the double-edged sword. Let's talk about how Snowflake actually makes its money.
So unlike traditional software where you just buy a fixed license, Snowflake uses a usage-based land and expand consumption flywheel. It works like a chain reaction. Step 1, customers consolidate their data. Step 2, they start running AI inference natively using tools like Cortex. Now, because AI workloads are so incredibly compute-intensive, Step 3 kicks in. They burn through compute credits way faster than standard queries, which leads us to Step 4, instant revenue expansion. It's brilliant, really, because it perfectly aligns Snowflake's revenue growth directly with their customers' AI usage.
However, there is a catch. When we look at their net revenue retention, or NRR, we see the story of a maturing company. You can see the trend where it's moderated from this dizzying peak of 178% back in fiscal 2022 down to 126% in the first quarter of fiscal 2027. Now, to be clear, 126% is still incredibly healthy. It literally means the average existing customer is spending 26% more than they did last year, even if Snowflake didn't sign a single new client. But it definitely shows us that the blistering, chaotic pace of their early expansion is starting to normalize. This leads us right into Section 5, the Databricks and hyperscaler war, because Snowflake is definitely not fighting in a vacuum. The valuation gap between Snowflake and their chief rival, Databricks, is wild. Just consider this comparison. At one point recently, public markets valued Snowflake at around $52 billion, which is roughly 9 times their forward product revenue. Meanwhile, the private markets slapped a massive $134 billion valuation on Databricks. That's roughly 25 times their run rate revenue. It clearly illustrates this huge premium that the private markets are placing on Databricks' specific AI infrastructure story, at least compared to how Wall Street is currently pricing Snowflake. And it gets tougher because it's not just Databricks they have to worry about. Objectively, Snowflake also has to fend off the hyperscalers. Literally the very cloud platforms that their software runs on. Amazon AWS, Oracle, Microsoft, Google, they are all heavily incentivized to keep enterprise AI workloads and data locked exclusively inside their own ecosystems. They are pouring billions into building out their own competing, highly integrated AI databases and tools. It's a fiercely competitive landscape.
Let's bring this all together in our final section. Section 6, Strengths and Market Risks, the final verdict.
When we synthesize all of this data, a really clear picture emerges. Over on the strength side, Snowflake offers this incredibly appealing cloud-agnostic architecture. This is a big deal. It means you aren't completely locked into AWS or Google. Combine that with their unmatched data gravity and that accelerating 34% product growth rate, and they look incredibly strong. But over on the risk side, you have the inherent unpredictability of a consumption pricing model, those heavy gape operating losses we talked about, and the undeniable reality of battling some of the absolute deepest pockets in the entire tech sector.
So, what does this all mean? Ultimately, it comes down to this one crucial question. As enterprises race to deploy intelligent AI agents, will the sheer gravity of having all their data already sitting inside Snowflake be enough to keep the company at the true center of the AI revolution? Or will these massive tech giants successfully bundle their own tools and just reclaim the throne? It's going to be an absolutely fascinating battle to watch unfold. Thanks for joining me for this explainer.